It's been a mainly equities thing, this worry. The trade fears have mainly played out in the equity space. What does it take for it to spill over into the FX and other asset classes, Themos?
Your question is has many different legs. The first thing is that if you look at the fundamental setup for volatility, this is an environment where, because output gaps are still shrinking, typically growth implies that volatility is, although not at 10, it's somewhere like a 15 to 20 kind of level vols for equity standards. So some of the spikes in volatility that we've seen in the equity market have been uncharacteristic to the cycle, and therefore they're much more close to the situation you're describing. If the cycle is to prevail, probably equity vols are more likely to converge towards FX vols rather than the other way around. Now, obviously, the other question you're asking is how does this trade war affect currencies? And the reality is that although there's a consensus, or there used to be a consensus that the dollar would strengthen on the back of such trade tensions, the reality is that in practical terms, this is very hard to happen. There are a lot of side consequences of how things are happening. So, for instance, all this discussion yesterday about China moving its currency left or right has a direct impact on the euro, which is actually positive rather than negative. And we saw that happen yesterday. So the effects on currencies are not particularly straightforward. What we wrote last year was that the dollar would actually weaken, which tends to be a low vol situation for FX whenever the dollar weakens, and trade tensions would not change that, and that's what happened actually. There are certain currencies where trade bites a lot more, and those currencies have been volatile, and they've been also volatile for their own reasons, including, for instance, Canada, and that may remain so for unrelated reasons as well.
Sharon, I keep reading that outside of recessions, such stock market volatility and such sizable decline should warrant investors to buy equities. Is it as simple as that or not?
It's interesting what Themos was saying about maybe equity volatility is a bit too high at the moment and perhaps reflecting too much of that risk and should perhaps come down a tiny bit. I probably agree with. I think that outside of recessions, and we are not forecasting recession, most people are not forecasting recession now. Most places in the world perhaps have a little bit more room to grow. They've got a little bit spare capacity. In the case of the US, I think growth is going to be supported by the fiscal easing, etc. So I think recession over the next year is relatively unlikely. Volatility should come down a little bit. So in that sense, it may be a buying opportunity. But and valuations have certainly come down now that we've had a bit of a correction in the data.
Lowest since Brexit.
There's valuations are not. In the case of Europe, which is my focus, for example, PE ratios, etc., are at long-term averages. They're not super high. Whereas, say, the yield you get on bonds is incredibly low. So I still think equity is reasonably attractive as an asset class. I guess my main point would be that relative to last year, where everything was great, got really good returns with very low volatility, you're probably going to settle at a slightly higher level of volatility now than you were at last year, but probably not as much as we've had in the last couple of months.
And probably a lower level of returns as well, to some extent.